Okay, now we are fine. We can start. So, yeah, so the recording is now on. So today I want us to to check on the issue of ETFs and unit trust, because usually these things they seem to be like one, but they are different, and usually people make mistakes of investing in unit trust without understanding it's a unit trust, because some they assume it's an ETF. So I just wanna split the two and explain them what is a unit trust, what is a ETF, so that when you make those decisions, we make informed decisions. And at the other hand, the reason why I brought this subject, I want us to maximize our potential in terms of investing, not to be cornered in one thing, but to maximize our potential, and also to have options, because the more you're knowledgeable of things is the more you're able to make a choice which one you want to go for, which one you want to just have knowledge of it but not pursue it. So it's good that we have this kind of knowledge or this kind of information, so that when we make those decisions, we make decisions while we have options and choices to pick on, which ones to pick on, which ones we can skip. So I'll just revamp again, going back to the ETFs, just to bring a brief again to explain them what are ETFs, and so that we'll be able to catch up with ETFs and unit trust. So an ETF, as I've said, is a basket of securities that tracks the performance of an underlying index, like the JSE Top 40, biggest listed companies for, okay, for example, or an asset like gold. So when you look at this, like this kind of ETF, the what is so called, the JSE Top 40. The JSE Top 40, it focuses on the top performing companies in South Africa. So, and then it's good because I'm using the top 40. So when you speak of um, an ETF focusing on the top performing companies of South Africa, in other words, they traced all the companies that are performing well in that season. So there might be changes in those 40 companies, but their main aim it is to focus on companies that are performing well in that season. So you might see this one may be not performing well, others are catching up, then you'll see them now also coming in. So this ETF, it contains all the top 40 companies which are performing well in the market. So the big benefits of an ETF, you get an instant diversification in your portfolio, a big win for any investor, plus you generally pay lower fees. So ETF can contain many types of investment, including stocks, commodities, bonds, and mixture of investment types. An ETF can own hundreds or thousands stocks across various industries, or it could be isolated to a particular industry or sector. So usually the ETF, sometimes you discover that they focus on a certain industry, or sometimes it contains different stocks. You remember our last class, I spoke about those ETFs that we're talking about, that some they carry around 300 to 300 and something, some to 3,000 stocks in one basket. So ETFs, it depends on what kind of ETF are going to pick. So others they focus on industries. So the other advantage is that if that kind of a basket is focusing on different industries they don't usually perform similar at the same time. You discover, for instance, during the COVID season, the industry of medicine, it was on a high scale, because medicine was on demand. So ETFs that were focusing on health and medicine, they were doing well. And if in that basket you have the mix of maybe others that are focusing on IT, and others that are there they are on medicine, others that are there they are focusing on supermarkets. That time supermarkets, medicine, and technology, it was doing well. That's why many people have bought the Zoom individual stock in the US market, because that time it was really performing well, and it took time for Zoom to pick up to that level, and then later on it went down, because as far as now people were more in the visual world, there were a lot of things that were introduced in terms of connection. So when industries changes, they don't change all of them at the same time. I discovered that this one industry is doing well, the other industry is not doing well. So when you are in ETFs, you are safe. Like if it was an individual stock, that's where the disadvantage also comes in. Let's say I've invested in a company that is an agricultural company, and discovered that at that time in agricultural sector they're not doing well. It means that stock won't be performing. But with ETFs, because it's a collection of different companies, one company may not doing well, but does not affect the overall of the basket. So one company may not doing well, discover that the others are doing well. So while the others are doing well, they're going to uplift the burden in that basket. So in other words, the performance in terms of your basket will be doing well because it does not depend on one individual company, but it's a collection of different companies in one basket, depending whether that basket carries stocks, whether it carries whether it is an ETF that focuses on different industries, or it's an ETF that focuses on a certain sector. So it depends on that. But one company or one industry may not doing well, but it does not mean necessarily the whole ETF it will go down, because it contains different, it's a mixture. As I've said, it's up to our choice which one we pick, which ones we pick. So if it's an ETF that focuses on different sectors, in other words, one sector will maybe one or two sectors are not doing well, but the others are doing well, which it makes it more easier for that ETF to perform well. And the other advantage is the issue of here in terms of the cost of owning that basket. So it's the fees are less. The fees are less, and which is something great. Looking at the current state where we are in terms of economical changes, obvious when you go to I just want to give an example by commercial banks. If you go to to commercial banks and say you wanna do an investment, it's going to be costly, because the cost of holding that investment in terms of commercial bank is expensive. And what affects the investment at the other hand is the issue of what is it called, the cost of living. As far as you saw that we were supposed to have a budget speech, but it was delayed because of that fiction that they had, and saying they are arguing in terms of the minister wanted to propose the issue of increasing VAT by 2%. And once you increase VAT by 2%, obvious the central bank, which is the South African Reserve Bank, is also going to increase interest, and the interest that are going to be increased are also going to affect also the cost of production. So if the cost of production is affected, everything is affected, meaning the value of your money won't be equal to the demands that we are having. And I was also thinking of it as far as I'm talking about this. I was also thinking about it that we also need to you are not yet in the subject of retirement, but I strongly believe that we need to revisit our retirement plans, because if economically we're going to have changes, we also need to adapt in those changes and see how we can equalize. Because if we don't catch the momentum of the change in the economy, we won't be able to suffice the needs which we have. So if we want to suffice the needs that we have, we need to catch up with the velocity of the changes in the economy. So it might happen that maybe in the past 10 years, it was easier for me to live and depend on one stream of income. But as far as things are changing, we're living in the days where it becomes more difficult even for one individual to depend on one stream of income. So there must be ways in which we're going to subdue that, to find ways in which we are going to be able to go through around this, and then also be able to go back even to our budgeting, to deal with our budgeting in terms of how do you hold on in such seasons, and how do you adapt, which are the changes that we need to attend to as far as there are changes in the economy. So going back again to the investment, if you can ask me even today, which one is better between investing in the ETFs and investing in the commercial bank, I'll still choose ETFs, because the cost of holding this investment is less compared to the cost of holding the investment in a commercial bank. The cost of living is against me, inflation is against me. So the value of my money is not determined. Even if they can say to me, I'm going to give you 7%, my 7% should be calculated based on the cost of living, and also be calculated by the value of what it's going to bring when I withdraw that kind of money. So I will always stick with the ETFs as long as the commercial banks are still running with those policies that they're using. I won't go through that line. So that's the advantage of ETFs. Even when you go to ETFs and individual stock, in individual stock, we speak about your Capitec shares, your Absa shares, your Nedbank shares. Those are individual stocks. When you compare the cost of owning an individual stock and owning an ETF, the ETF is way cheaper compared to owning an individual stock. Hence, when startups start, we always advise them that you better start with ETFs and you're going to go to individual stocks later. We're not saying individual stocks are bad, but we're saying if you want to start good as a starter, it's good for you to start with ETFs and then build your momentum into ETFs, in investing in different ETFs, others that are also paying dividends, others that are also promising to grow. And then you invest into that and you grow through that in that process, which is very, very much critical. So ETFs, they have that advantage of lesser fees, accessibility in terms of accessing different companies in one pot. So you have one pot that contains, okay, it's like when you speak of ETFs, it's like you're speaking of a basket which you have bananas, oranges, apples, pears, everything that is in them. So when you pick the basket, you're not picking an apple, you're not picking an orange, you're picking the whole basket that have oranges, have all this fruit in it. So the ETF gives you that advantage. But when you speak of individual stock, you have to pick one in the basket. It's either you pick an orange, it's either you pick a banana, but you can't pick all of them at the same time. You pick one. That's why we call them individual stocks. But when it comes to ETFs, you pick the whole basket at once. That's the power of its value. While at the other hand, you have to pick one by one, which is costly sometimes to pick one by one. Here you pick the whole basket, which gives you now what a good advantage because you have already chosen the whole basket instead of picking individuals in the basket where you pick a fruit. I mean, when you pick a banana, you pick orange. Later on, you must come and pick an apple, so it becomes costly. But this one is managing the whole thing in one basket, which gives you what lot of advantages. And when then the question will be always like I'm continuing with that session that we left, that how do we pick up ETFs? So here I'm stretching again going forward. How do you choose, or how do I choose an ETF? So here are the simple things which now, today I'm basing it more on personal decision. Last I was basing it more in terms of having the right information about an ETF. But now I'm going more to you as an individual. So, number one, when you pick these ETFs, number one, know your goals as an individual. That's why you need to define your goal. What are your goals as an individual? Our goals, they differ. Our goals, they definitely differ. So, it might happen that my goal it is to use this investment. Maybe I'm planning to use this investment for my children's education, or maybe I'm using this investment for my retirement. You see, now the goals becomes different. So when as an individual, you need to define your goals. So as with most things in life, choosing an ETF starts with knowing what you want. What is it exactly that pushes you to invest in the ETF? So you must write your goals, because your goals will always be the radar that drives you in terms of which direction you're going to take. So what's your big investment goal? So are you planning to save for a holiday abroad? Or do you want to start your own business? Or do you want to purchase your first home? Or you save for your child's education? So what is your goal exactly? You must have a goal. Don't just go into the market without a goal. You must have a goal. Why is it critical? Some of these goals are more short-term, a few months or to a year. When you speak of a short-term goal in terms of investment, I speak of something of a few months to a year. So some are more long-term. Long-term, we speak about 10 to 20 years. So the time factor really matters. So if you're investing for between few months and a year, it's a short-term goal. And then, in other words, if you go for those ones, I mean, if you go for a term of like few months to a year, there are specific ETFs that you need to invest into, because it's for a short term. So I'm going to share about that when we go down. So if it's for a long term, still there's some ETFs that you can pick up. You can pick. So because time factor really matters when it comes to this. So if it's for a long-term goal, it means I'm going to hold this thing for more than 10 to 20 years. And then I'm going to have what is so-called an exit plan. What is your exit plan in terms of these things? Because we are not going to sit here forever. You must have an exit plan that after 10 years, I'm going to withdraw this, and then I'm going to bring it into this pot, or I'm going to use it for my child's education, because after 10 years, my child will be passing his or her own grade 12. That's it. I want to start a new lifestyle using these ETFs after retirement. I'll be staying in this place, and I'm going to need this kind of amount. That's why I'm starting to invest like this kind of in this kind of ETF that I've chosen. So it's definitely up to you. What are your goals? So it's critical when, as an individual, you need to define your own goals. So okay. Number two, know your timeline. As I've said, the factor of time plays a major role. You need to know your time. So as I've said, that for short term, there are specific ETFs that you need to invest to. For a long term, there are specific ETFs that also need to invest. So for short term investing, if you want to go for short term investing, lower risk ETFs are worth considering. If you want to go for a few months to a year, lower risk ETFs are worth considering. This means it will grow less aggressively and offer you a lower return. That's the reality of investing in a lower risk ETFs. They're not going to give you that much. They're going to give you, in terms of growth, they're going to experience a less growth, because these are not ETFs that are for a long-term goal. So, but you will be less impacted by any market movements if you invest in this. So if you want to invest for a long term, higher risk ETFs are better idea. They usually offer a higher growth, while the chance of setbacks is higher. Your investment also has the best chance of recovering from any losses over time, because it's for a long term. For instance, during that time of COVID, COVID, it went hard to countries like China. So ETFs that were focusing in the Chinese market, they were not doing well. They were very, very low. They were very low. So just imagine in that state, I was for a long term. In other words, if I was for a long term, in that period, it definitely comes, it will force me to withdraw from something which is in negative. But if I'm for a long term, even that time when the Chinese market was not doing well in the ETFs that are focusing in the Chinese market, even if I wasn't doing well, I had the time to say, but I'm here for 10 years. So I still have to wait for this to recover. And then 10 years still does have a space or a period where I'm going to recover this. So hence we have to consider those factors. Like, if you are for a short-term goals, you need to go for those ETFs which are not in that edge. But if you are for a long term, you also have the advantage or the space to recover if something happens, like stuff like COVID that happens, that led many companies not to trade as they used to trade. So it gives you the space to recover. Hence, I also urge young people to say it's good for you young people to start early, because it gives you a lot of time. You don't have more responsibilities. You still have time to recover. But people who are in their 50s, they're expecting this thing to move like boom, and it goes up. But sometimes the market goes down, which now the value of your investment also goes down. It comes up. So if they are still young, they still have a lot of advantage to say, I can recover at any time. Even when the market is going down, I'm going to recover. When the market goes up, I'm going to recover. So ETFs that track instruments like money market and bonds are good for short term. So if you want to go for short term, look at ETFs that focus on money market and bonds. These ones, they are good for short term. If you want to go for short term, let's check for ETFs that are focusing on money market and bonds. These ones, they are good on that. We have South African, we have SA bonds. We have, you can check South African bonds. You can check, if you want to go for that, you can check in terms of the bonds. The bonds ETF are going to get them there. So if you want to go for short term, go for these ones, which are on money market and bonds. Go for them. So, however, if you are looking to invest for more than a year or two, ETFs with local and international equities are better. So you'll go for local and international ETFs. So international ETFs, and then you go to the S&P 500. Though now there is this noise in the US because of Trump and Elon Musk doing all this ups and down. I believe they'll still catch up in terms of the S&P 500 and other companies. So if you wanna go for a long term, go for local and international ETFs. Have the mixture in there, the local and the ETFs. That if the local market is not doing well, probably the international market will be definitely doing well. So these are the ETFs that you can go for if you're an individual who's focusing more in the long run. You're not a person like who's focusing on the long run, or something like you wanna do maybe during festive seasons. If you wanna go for a long term, you better stick to local and international ETFs. So now let's go to the next slide. Okay, well, how do you choose? We are still there. So number 3, diversify to reduce your risk. Diversify. When it comes to picking ETFs, you need to diversify. When we speak of diversification, speak of, they always say don't put your eggs in one basket. It speaks of splitting your investment. You can split it according to different industries. You can split it according to what's it called, in terms of local and international ETFs. That's diversification. You're not putting your eggs in one basket. So a way to reduce your chance of losing money risk is just to consider investing in an ETF that covering a wide range of stocks, like those ones that we shared last week, that they covers around 3,000 upwards. This is so-called spreading your risk. Spreading your risk. So by spreading your money across multiple shares, so you will reduce the risk of losing lots of money should be any single share not perform well. When you speak of losing, don't speak of losing as losing for good. You speak about it going down in terms of value, because it's rare in the market to lose money. Say we lose money for good, because the only way in which a person can lose money in the stock market is when that certain company which I have invested in decide to shut down and close. That's where you say this one is liquidated. Maybe it's liquidated because of debt or anything else, which is a rare factor in terms of the stock market. And also the critical part, usually these things, they happen to individual stocks. These ones, the individual stocks, what you necessarily do when you invest in them, you check their cash flow, you check their balance sheet, and read in terms of debt and everything, because those factors will help you to say, this company with these big debts, are they going to be able to recover from this? You ask yourself, these ones are not going to be able to recover, because some companies in the individual stocks, they use a lot of money to give people what's so-called dividends. You discover that they are good in giving dividends, but when you check at the performance of the company is not performing well at all. So in addition, having a mixed different ETFs in your portfolio helps you to reduce the total risk. So okay, let's skip to the next slide. Still on how do we choose ETFs. This is the last point in terms of how do you choose an ETF. So number last is understand the cost involved. This is something which I spoke about last time, but I want to emphasize on it again and again. Generally, ETFs, they have lower fees than other options, but not all ETFs are equal when it comes to cost, even when it's tracking the same index. So you need to know the total expense ratio, which is called the TER. So that's the total cost to manage and administer the fund. And last week I've showed you guys, I even sent you a link in terms of how do you check the total cost of owning that share, or what is so called the total expense ratio. So it's critical that you check that, because if now my total expense ratio is high, even if my what's so called my ETF is growing, the value will be chowed by what by the expense ratio. So you need to check the expense ratio. So the lower the expense ratio, the bigger the advantage in terms of what is so called of getting bigger returns there. So You need to check that. It's critical. Always, you can use that link that I've sent you. You can use that link to do your own comparisons there, to check the total expense ratio, making sure that the total expense ratio of your ETF is less. You can even do that in terms of individual stocks. If you want to check individual stocks, into checking the total expense ratio. So because they differ, they may be tracking the same index, but they differ in terms of how much it costs. Usually when I check those things, I just drag that thing and put it to 0.5. 0.5 is the lowest, and then to 0.5 and check how many can I get in terms of 0.5. But also not ignoring the fact that I'm not just going for the expense ratio. I'm also looking at the performance of that type of ETF. So these are the four things which I find them critical in terms of helping you to pick the right ETF. So now let's go to the unit trust, because I want to match the two, unit trust against the ETFs. What is a unit trust, or what are unit trusts? So I just want to give a brief of what is a unit trust. So I'm sure you have came across stuffs like your Allen Gray ETF, and you are asking yourself, what is this managed return Allen Gray or Old Mutual or FNB? Those are unit trust. And then also in if you're using his equity, you'll notice something called the unit trusts are listed. This is the list of unit trusts, and you go there, you'll find the unit trust, and you ask yourself, what is this? So the unit trust is a fund that pulls money from investors who have similar goals to invest in listed securities chosen by the fund manager. So unit trust there's a bit similarity when it comes to unit trust and ETF, because they also contain some they contain stocks, some they contain different commodities. So but the difference now when it comes to this, I'm going to share the difference between unit trust and ETF. But one of the difference which is the major when it comes to ETFs and unit trust, the unit trust, they have what you call a fund manager. A fund manager is a person who's well equipped in terms of investments. So the fund managers are the ones, like when you invest in unit trust, it's like you give me your money and say, go to the market and pick the right stock for me. So I'm responsible to do all the researching and to manage it. So that's why you discover that the cost of owning a unit trust is higher, because you need to pay that individual who's doing the work for you. So in this state, you are not doing the work. There is someone who's doing the work for you. So that's why even when it comes to unit trust, they're not like ETFs. So you say an ETF is 5 rand, 10 rand. They have specifications that you need to put this kind of amount in this period, or once off, or you need to repeat this for this month. They have specifications. So when it comes to unit trust, the unit trust is like it's a pool of money from investors who have the similar goals, and to achieve these, they're going to need what is so-called a fund manager. So the guys who invest in their unit trust, their investment is managed by what is so-called a fund manager. So you'll find your Allen Grays, you'll find your Old Mutual, you'll find the FNBs in terms of unit trust. So they have special guys who are there, who are dealing with this, who are managing this investment. So let's think of it like going in a group, or in on a group gift. So take all together, those investments are called the fund's assets. So while you as an individual invest in a unit trust fund, the fund itself is run by a fund manager whose aim is to grow the overall value of the unit trust fund. So the goal of the fund manager is to make sure that your money grows. That's his ultimate goal, because he needs to make sure that he pushes this thing and he invests in right stocks. He's the one who's doing all the trading work for you there, while when they are sitting there. So the fund manager does this by investing the fund's assets, usually by buying stocks, bonds, or combination of these two securities which are listed on the stock exchange. So some unit trust funds can buy more complicated securities types. If you are looking for an affordable, convenient, and professional way of investing, then unit trust is for you. So unit trusts are also highly regulated. As I've said, they're also highly regulated. So it gives you, the investor, peace of mind that their funds are safe. So when as an investor, you know that My funds, there's a fund manager who's in charge of it. So ETFs, you don't have a fund manager. But unit trust, you have a fund manager who manages your investment. So his duty every day is to trace and to track which stocks and bonds that are doing well, and then you have to trace and then be able to invest into that. That's the duty of your fund manager. So you invest certain funds, and the fund manager will do the work. So let's now break it down in terms of what are the differences between unit trust and ETFs. Number one, the main difference between ETFs and unit trust is who chooses the assets that are in the fund. So with the unit funds, we have a fund manager, fund managers who choose the assets they believe will beat the market. So basically, the objective of the unit fund is to beat the benchmark, as to beat the market, as to perform better than most of the ETFs and other unit funds. So here, as I've said, here in terms of the unit trust, the fund manager is the one who chooses. But when it comes to ETF, it is you who chooses. So when I just choose a unit trust, whether it will be Allen Gray or that will be FNB, just choose. Then the guys will do the work behind the scene. They will be the one now picking where to invest this money, where like they'll collect, like they collect, like I put my money, let's say, let's use Allen Gray. We're in Allen Gray. I put my money, put your money. So like at the end of the day, all of us were 100, and they collect that money and see how they rotate that money in different investments. Their benchmark is to beat the market. So they are always trade, like I'm sure you have seen some guys sitting on screens with some graphs there. Yeah, those are the guys who study the market. Their aim is to beat the market always. They want to beat the market. That's their ultimate goal. They want to beat the market. So now, as an individual, when you invest in ETFs, you want to beat the market. But the difference is that those guys, they work, is their job. It's their job, full-time job, to sit on those screens, to study the market, to study factors, to study the Reserve Bank. Because when it comes to these, there are guys who study the Reserve Bank, there are guys who study the market, there are guys who study the economy. They have different jobs there. So that's why we call them fund managers. So here the first difference is that here the choosing part is done by the fund manager. So now let's go to the ETFs and check the ETF. And and the assets that are in ETFs are chosen by the market. So the ETFs just check what happens in the market. So the ETFs that you get, the assets that you get on ETFs, whether it's the top 40, whether it's those ones that are chosen by the market, not by the fund managers. But when it comes to unit trust, those ones that are chosen by the fund. So, okay, let me just illustrate in a simple example. In the basket of unit trust, is like a person who's entering in a garden with different trees of fruits. They go around and check the best. And they say, okay, this will do this. And they say, this one will do great. They pick it, this one will do great. And they don't just pick, they pick based on factors. Okay, this one will do, they pick specifically there. This fund, but they're hired, this fund managers, like they're hired by you because so they also pay them. So when it comes to ETFs, these ones, they are chosen by market. The assets which you find in the ETF basket, these ones, they are chosen by the market, not by the fund managers. They are chosen by the market. So I'm going to explain how the market chooses these ones. So for an example, the top 40 ETFs follow the top 40 of the JSE. So no one chooses the top 40. They just look at what is in the top 40 in the market, and they just follow that. So what they do, they go to their list of all the listed commodities that are listed in the stock market, and they check the top 40, which are the ones which are top 40, which are performing well. And then they pick that, and then they put them in one basket, regardless of which company. As long as that company, it falls under the top 40 companies who are performing well in that season, they pick them and put them in that one basket, and they call it the top 40. While there, in terms of the unit trust, these guys that are picking in the unit trust, as we call them, fund managers, they study They don't just pick the top performing. They study and say this one will be performing well, maybe for this period. They have factors when they choose. So here, in terms of the assets that the assets which are the companies which are in the top in the ETFs, it's chosen by the market. The market will just look and say, okay, if we're going to pick the top 40, they just go and let's pick companies that are performing well. So they're going to check at their list that is performing well. That's why as I go down, you'll see that the performance, like the guys who are in the unit trust, they can beat the performance of the market because of some factors which I'm going to share here. So the objective of the unit trust is to beat the market. The objective of the unit trust is to beat the market. And what is the objective of the ETF? The objective of the ETF is to match that benchmark, so they are not trying to do better than other ETFs. They're not trying to do better than other unit funds. They're just trying to be where the market is at. So with ETFs, their object is not to beat the market. The ones with the object of beating the market is the unit trust. But with the ETFs, their object, it is to make sure that they match companies which are always performing well. That's their benchmark. They're not comparing like wanna beat this to this. The ones who do that are the guys who are using the unit trust. They are unit trust guys that they are their main object. As I've said, they are hired by you to make sure that they invest your money in a space where it's going to bring value. So ETFs are not trying to do better than other unit funds. They are just trying to be where the market is at. So they trace the market. So, okay, they just match and check the market. So if the market is going up, the ETFs will go up. Okay. They just match and check the market. So if the market is going up, the ETFs will go up. If the market goes down, the ETFs will also go down. You see the difference? With the ETFs, they trace the market. If the market goes up with your investment, it will definitely go up. Now let's check the unit trust. What happens if the market goes down and goes up? But the unit funds, on the other hand, when the markets are going down, they are trying to beat the market. They are trying to make sure that when the market goes down, they are going up. And then when the market goes up, they are going even higher. So the unit trust guys, they can beat the market. Why? It is because they study the things that they have invested in. Like they make sure that we move, like it's like a person who's running away from traffic. They will always find a loophole to escape. So these guys, they will always study the market. Okay, is the market's going in this direction, you need to go to this direction because it's their work. So with ETF, since they trace in terms of the top 40, they trace how the market is performing in investment. So possibly when the market goes down, the ETFs will also go down. When the market goes up, the ETF will also goes up, because this one they are chosen by the market. So it's a factor which depends on the market, while the unit trust is a factor which depends on the fund managers who manages this, making sure that the route to beat the market is this, the route to beat the market is this. So at the one part, you have people who are working to make sure to guard their investment. At one part, you have the market following the performance of how everything is going around in the market. So you'll see after the news that they say the market has been in this level and explain everything. So if the market is performing well, you'll see that the ETF is also performing well. So let's check the other difference between the two. Let's hope I'm still in time. Okay. Let's check the second difference is that is the prices of the units and the prices of the share in the ETF. With an ETF, the price changes like is a share. It's a share price, or like a company share price. You can see the price changing throughout the day. On the other hand, the unit price is updated at the close of the day, so that at the end of the day, every day, they update the price based on the assets and all the evaluations that they have to do so. In summary, the price of an ETF changes through the day, and the price of the unit is updated after the market closes. So with the ETF, you can read that maybe 9 o'clock when the JSE opened, it was sitting on 20 rand. 10 o'clock is there on 21 rand. 11 o'clock is back to 19 rand. You can see all this movement with ETF. But with the unit trust, that thing is updated. It's updated after the market closes and when the market opens. So it's updated after work. It's after, because these guys, they need to gather information to check and to evaluate everything. So it is you will see it. So something that you will see now changing, like an ETF changes like what is so called like an individual stock, because with an individual stock you can see all the changes throughout the day. When I started to invest, I used to like at 9 o'clock I was there, 9:30 I was there, like checking down. And now I can spend months without even checking or bothering myself. So with an ETF, you can see all those changes, but with the unit trust, you'll see it after a day when the market closes or when the market opens. That's how it goes. So the okay, the third we miss the third. Okay, the third difference is the fees. When it comes to the fees, you have a big difference here. So it's very much important for you to check how much you're going to pay in order to invest in a certain fund. We spoke about the issue of the cost of owning any investment that you're going to own. So it's critical for you to check, because you can say, okay, it's good, we have someone who's managing our money there, but it's a question of how much does it cost, and then looking at it and calculating the value of an investment based on your goals. Because I spoke about having a goal. They say, okay, if it goes like this, it means after this time around, it's an estimation, I'm going to be in this level. So unit funds, unit trust, or unit funds have higher fees because they have people managing these funds. And ETFs have lower fees because they are just following their markets and no one is choosing anything. They don't have fund managers and the things like that. So the percentage of fees that is taken from your investment can make a huge difference in terms of how much your investment grows. So it's very much important. We need to look at the fees and look at the performance of that fund. I think this is very much simple. It's a simple factor. Taking the price, like how much will it cost you to invest in the unit fund, and then you study it on terms of your goal. If I'm going to invest for 2 years, they're going to take this kind of amount for 2 years, and then you look at it. Am I going to for this? I'm going for that. Because with unit funds, there are people who are managing it, and there's people they need to be paid. While with ETFs, there's no one who's like you're going to pay. There's no fund manager there. We don't have a fund manager when it comes to ETF. So it's a huge difference there. So you need to check, you need to calculate. You can have that excitement, as I've said, the excitement of saying, oh, we're going to have someone who's going to be managing our money, beating the market. But you need to check the cost of that. You need to check the cost. How much will it cost you to own that what's so called that unit trust or that ETF? And you have that link. You can check in your link there and just check, and then check and finalize everything before you make your own move. So let's check our last slide, and then we'll open for questions if there are questions, and close if there are no questions, and then we're going to meet again next week. So the fourth difference is that is the minimum investment required of these funds. So with the unit funds or the unit trust, usually they will say that monthly you have to deposit a certain fee. So when you want to invest in unit funds or unit trust, they will tell you that maybe every month you need to put this kind, or you need to allocate this kind of amount. For example, they will say 500, or for you, or once off investment, you have to invest 10,000. So they'll give you a certain amount. So does it different? Give a certain amount that say, okay, if you want to invest in this unit trust, you need to put this maybe 500 every month for this period. While when it comes to maybe they say you need to put 10,000 once off. But when it comes to ETFs, you don't have that. I know most of us have already invested in ETFs. They don't have that specification of say you need to have this kind of amount. You can invest as whatever amount you have. So, but with ETFs, they have specifications that yes, either you put 500, it's an example of 500, you put 500 every month, or you put 10,000 once off. So ETFs, you can buy from 10 Rand, you can buy from 100 Rand. It depends on which one you want to go for. So the fifth and the last difference is this. Difference is how the fifth difference is how you can buy and sell these portions. So with an ETF, you can buy and sell whenever during the day. And with unit trust, you can only buy it once a day because they still have to process their closing price. So if you want to sell it, you can sell it in the next day. You can't buy and sell it in one day as you please. So when it comes to ETFs, you can buy now and sell it later. You can sell it, buy now and sell it, buy it and sell it. Though it will sound like now you are doing trading, but you can buy and sell it, buy and sell it. But with unit trust, where if you buy it today, it means you're going to sell it tomorrow. You'll have to wait because they'll need to evaluate and come up with the price. What is the value, or what was the value when the market closes? As I've said to you, after the market closes, they'll have to do some evaluations and check what is the value of that unit trust as the market closes. So if you want to buy this, you have to calculate, or you have to understand these factors. So these are the differences when it comes to ETFs and unit trust. And I find it more critical because we have unit trust there, and some people, they can just jump into unit trust without understanding what is unit trust, what is going on in terms of unit trust. But you need to understand these things, and you need to make your own research in terms of the cost. What is the cost in terms of owning a unit trust? If you want to invest in trust, what is the cost of ETFs? Because even in ETFs, you see that you have to check the cost. What is the cost in terms of investing in this ETF? But as I've said, when it comes to unit trust, you have fund managers, while at the other end, when it comes to ETFs, you don't have a fund manager. It is decided by the market, chosen by the market, and it's up to you how you go around everything. So yeah, let's pause here for tonight and process this information which I've shared. Yeah, I don't know if there is a question or if there are